Hey, what's going on, guys? Welcome to another video. Today we are going to talk about why you should never, ever in your life try and time the market. And so in today's video, I'm going to go ahead and lay out some real life examples of why timing the market is both impossible and why it is something that you should never try to do if building wealth is something that you want to do in the long term. And so let's just go ahead and get right into it, right? So we know that in 2020 and 2021, after the market crash that happened regarding the pandemic, the market just went nuts. Stocks literally just went up for the last like 2 years. And because of that, a lot of people have this false notion that they can time the market because they successfully did it in a market cycle where stocks only went up. But over the long term, people are going to eventually come to a rude awakening like they have so far in 2022 when they start to lose some of their money. And I'm trying to stop you guys from doing that. So let's start off with what happened this week. So on March 16th on Wednesday, the Fed basically announced that they will be raising rates by 25 basis points. And leading up to that time, a lot of people thought that the markets was going to crash. You had a lot of YouTubers and finance people on Twitter saying that the market's going to crash, it's going to go down lower, we're shorting the market, I'm buying puts. And what happened? The S&P 500 posted its biggest two-day rally since 2020. And it's just something that a lot of people didn't see coming. And that's the thing about the market. Normally, whatever you think is going to happen in the market, the opposite almost always happens because you just cannot predict this stuff. The market is extremely complicated. And no matter how smart and sophisticated you may think you are, even if you follow economics down to a T, it doesn't matter. You cannot predict these outcomes. The market is it's not rational. The stock market is not a rational place. So you can't think rationally and try to time the market. It's just not going to work. Now, Bank of America did a study on the difficulties of trying to time the market. And from looking at the data, going all the way back to 1930, what they found is that if an investor missed the S&P 500's 10 best days each decade, the total return would stand at only 28% for the decade. If, on the other hand, the investor held steady through the ups and downs and just held their stocks and didn't try to time the market, their return would have been 17,715%. Many investors are often emotional and cannot handle a large plunge in stocks. However, Bank of America actually found that the best days in the stock market often followed the largest plunges. And so what that basically means is when you try to time the market, historically, you often end up missing out on the best days in the stock market because they often follow after the stock market plunges a large percentage. And so that's another reason why you can't and you shouldn't try to time the market because the long-term investors are often going to beat you. Another point I wanted to bring up is there are plenty of day trader millionaires on YouTube. There's this guy named Tim Sykes. There's this guy named Ricky Gutierrez on YouTube. There's a bunch of day traders on YouTube who are multimillionaires. However, the richest people in the world, like Warren Buffett and Charlie Munger, who's a billionaire as well, the richest people in the world who are billionaires got their wealth from long-term investing in the stock market. So sure, Johnny Day Trader might have a couple $100,000 or he might be a millionaire. But if we're talking really becoming rich and building generational wealth, long-term investing is the way to go. And history proves that long-term investors normally always beat day traders. Now, another major reason why you can't and shouldn't time the market or try to time the market is because even the pros can't do it. Even the best economists, the smartest financial advisors in the world, even the professionals in the stock market who have been doing this for decades can't do it. So here's another study. In 2018, the International Monetary Fund did a study, and in this study, they looked at 153 recessions in 63 countries between 1992 and 2014. And in that study, they found that out of 153 recessions, only 5 were predicted by a consensus of public and private sector economists. So if the pros can't even do it, there's no way you can expect yourself as a normal investor to do it. And furthermore, the fact that the pros were so bad at predicting recessions further proves my point that it is nearly impossible to try and time the market. And finally, the final reason why you shouldn't try to time the market is because of taxes. When you're doing frequent trades, when you're frequently trading, that's going to trigger what's called a short-term capital gains tax, which is taxed as regular income as opposed to long-term capital gains tax, which isn't taxed in the same bracket that short-term capital gains tax is taxed in. And also, when you invest in the long term and you don't frequently trade, you actually save more money in taxes, and paying less taxes to the government is actually a great strategy for building wealth, which is why it's actually much better to hold your stocks for the long term rather than doing 800 trades a year trying to figure out how to time the market when it's an impossible feat to do anyway. So instead of trying to time the market, what should you do? Well, I got a few steps for you. One is dollar cost average. I always say this, I've said this in numerous videos. You want to buy stocks the same way that you put money into your 401k. That is dollar cost averaging. No matter what the market's doing, no matter what your favorite YouTuber is saying, no matter how down stocks are, and your 401k, money comes out of your check, every paycheck, and a tiny bit goes into your 401k for retirement. That 401k is normally invested in a mutual fund, which is the stock market. You should be investing in stocks that exact same way. Dollar cost average in your individual accounts. Every week, 2 weeks, whenever you get some money, put a little bit at a time in small increments into the stock market. And over the long term, you will compound and you will do very well in terms of building wealth. The other one is buying index funds. Index funds are an excellent way to build wealth, and I say this all the time as well. People say that index funds are boring, they move slow, they don't give me a 100% return in 5 days like I can get a penny stock. Okay, fine. However, index funds are significantly less risky than buying something like an individual company. That's number one. Number two, even though you may only get an 8 or 9% return on average yearly, people don't take into account how powerful that return is if you have a lot of money in that index fund. So sure, 8% return on $10 isn't a lot of money. But if you keep adding money to that index fund and keep compounding and keep growing, 8% on $500,000 is very nice. And by investing in index funds, not only are you beating inflation over the long term, but you are also 9.9 times out of 10 beating every single individual investor who is investing in the stock market, even the pros, because studies have shown and history has shown that even the pros have a very hard time beating the stock market. So if you just invest in an index fund that tracks the overall stock market, 9.9 times out of 10, you're beating every single investor that's investing in the market. And so there you have it. That's my video. Hope you guys got a lot out of this. And yeah, that'll go ahead and conclude today's video. Thank you guys so much for watching. Feel free to like, share, and subscribe, and I will see you guys in the next one.